Is that red light turned on for anyone else? Oh, there it goes. Hello, everyone. Welcome to the May 30th edition of the Scientific Governance and Risk Meeting with MakerDAO. My name is Richard Brown. I am going to moderate the call today and talk a bit about governance and the recent votes. After that, we will talk to Cyrus, who represents the risk team at MakerDAO, and he's going to in turn introduce us to a bunch of really talented members of the community who are also helping us out with risk. And then after that, we're going to hear from Cyrus, who will start digging into collateral types and collateral risk, which is an interesting conversation we need to have as an entire community over the course of the next weeks, months, leading up to multi-collateral DAI. And then afterwards, if there is significant interest, we'll have a Q&A session that could possibly run past the top of the hour. We'll stick around until energy begins to wane. Generally, we've been hanging out for a half hour after these calls and just doing a general Q&A. And there's been a lot of interesting conversations. So if you're interested, please hang out for that. My preamble, I'm going to jump into again, is that we are intensely interested in getting as much feedback and questions, comments, and concerns from the community as we possibly can. We have an enormously talented group of people in these calls, and we want to know what they're thinking and get as much from them as we possibly can. Sorry, drifted for a second there. I'm digging up a link, so I'm going to paste this in the chat on the side. If people have questions or comments, please type them out in the chat, and we will attempt to get to those. And when there's a quiet moment, we'll read them out for you. If you have access to a microphone, please jump in and just start talking. There's no rules against interruptions here. If you think there's a thread that we picked up or dropped that needs to be explored more completely, please jump into the Reddit thread that I just posted, and let's continue the conversation there, because as always, this is a forum for us to discuss and to debate and to explore things and to surface new issues and to discuss memes and or educate ourselves and the rest of the community. But we don't really make decisions here. We make decisions through the voting portal, and we have deeper debates in Reddit over the course of the week. And so please make sure that your thoughts and concerns are known and recorded in those threads. Generally, we have Stephen come in and give us a thought of the week, but one of the main themes of these calls is that we're iterating every single time, trying to improve things, trying to tighten things up a bit. And one of the things we're trying to do is one of the ideas that we're wrestling with are how much information do we pack into these this single call? How many calls do we need to have in the future? What should the agenda of those calls be? Who should we advertise them to? There's a lot of questions that we need to answer. Do we need a separate risk call? Do we need 3 or 4 different separate risk calls? Do we need one governance call for monetary policy? Do we need another governance call for things like the DSR or the stability fee? There's all kinds of questions that need to be addressed. But in the short term, it's my preference that we keep this one primary call as optimized as we possibly can and as focused as we can. And as it becomes absolutely required, we can start fragmenting the discussion a bit. But until then, we're going to tighten things up a bit. And that means that Stephen's thought of the week is going to be migrated into more of a role where Stephen is a stakeholder like everybody else. And so as we discuss interesting topics or there's clarity that he thinks that needs to be addressed, he can jump in as a participant in the calls as opposed to sort of like the opener and the closer of the calls, which we've been doing in the past. In light of that, the desire for efficiency, I'm going to try and tone down my speechifying, because I've gone back and listened to a few calls and I've talked for 20 minutes without realizing it. I have a feeling that I'm getting there today as well, so I'm going to tighten things up. My discussion today, though, is around governance and voting, and that's going to be sort of my gig, has been in the past and will continue for the near future. I want to talk about how the vote has gone in the last 2 weeks, because we've seen some interesting behaviors that have surfaced, some issues and concerns that we knew could happen in the voting system, and we've addressed it in a way that we anticipated that we would have to. And that concern is that we have a continuous approval voting system where the idea is that maker holders signal one picture of the system or a new picture of the system. And as they have a chance to view how the ecosystem is behaving and the market is behaving, the peg is behaving, they decide whether they want the new executive to be ratified or whether they're happy with the old executive. In the past, we got past about 2 months, we got used to this idea of we got wrapped up in this thing which I call sometimes the new normal, where because something had happened a few times in a row, we assume that that's the way that the world is going to be from this point forward, and that's a risky thing to fall into. And that new normal assumption was that every Friday, maker holders would immediately jump into the voting portal. They would pick whichever the new vote was, because new is obviously better than old. Then we would proceed to enjoy the success of our governance system. And on Monday, we'd have a poll that was based on that very clear picture of the system that we all understood, which was clarified the previous Friday. In the last 2 weeks, some interesting things happened. A bunch of interesting things happened. The peg largely stabilized, air quotes and caveats apply. I'm not really qualified to figure out whether it has or not, but it seems like it has. A lot of the voters seem to have shared that same opinion, and there wasn't a mad rush to raise and or lower the fee on the Friday 2 weeks ago, and there wasn't one on the weekend either, and there wasn't one during the course of the week. And we ran into this situation where we began having polls that didn't reflect the current state of the system. They reflected what potentially the future state of the system might look like, irrespective of what the main voters were doing with the actual stability fee itself. So we had the stability fee at 19. There was a significant amount of signaling that wanted it to go to 17. So we saw a disconnect between signalers in the polling infrastructure and actual voters in, or people staking their weight against the actual executive. That was something that we need to learn about. It also surfaced some issues we have with the system in general, which is that our requirements are evolving faster than the governance portal is evolving. And one of the things we've run into, which obviously we all knew we would, is that you can only vote for one thing at a time, and that includes a poll. So if you have your maker staked in a poll that says you want to lower the fee, you need to take it out of a current executive that is lowering the fee, or vice versa. If you want to vote for a lower fee, you need to take it out of the poll, and that changes the signal. So we have all kinds of issues that we're addressing there, and we've spoken about in previous calls. Chris was from Product was in the call last week to give us solicit some information and show us how the portal will be evolving. But anyways, we ran into some issues about weak executives and confusing polls. Happily, that ambiguity was cleared up this week, and there's some very interesting things that happened here that I want to explore a bit, or at least put on people's radars. Is that there's a significant amount of data that shows that the peg is probably stable-ish right now. I'm not. I'll leave Vishesh and the risk team to explain why, because I don't understand why it's stable-ish. But the interesting thing is that instead of choosing to leave the fee where it was, under the understanding that it potentially is just working the way it's supposed to, maker voters chose to lower the fee a couple days ago. And that, to me, is very interesting for a few reasons. It sends a signal beyond whether it should have been lowered or shouldn't have been. I don't know. But the great thing about that change was it signaled to the community that our fees are not marching ever upwards, that the voters are more than willing to lower those fees when they feel that it's required. That takes the steam out of the wind out of a lot of people's sails in the contrarian MakerDAO community, which I enjoyed seeing. It also goes towards dispelling the myth that there's a correlation between the stability fee and the price of Maker, which is sort of a pernicious myth, and one that particularly annoys me because it's so immediately and obviously disprovable. Because if you look at the stability fees and you look at the price of Maker and you overlay those two graphs together, you can see that raising of stability fees is generally deleterious to the price of Maker. But this also provides some very, very interesting signals to the community that the fee does go down, that it's not exclusively the domain of a bunch of money-hungry plutarchs, and that ultimately, and this is the most important one, that there is a peg recovery in the future, and we've proven that that is a situation that can occur. And one of the interesting things that we might see in the future now is that the next time that cheap DAI does show up on the market, or there's a sufficient supply overshoots, people now have evidence, empirical evidence, that it will go back to the dollar. So it might be time to enjoy some arbing opportunities. So those are some of the things that I wanted to leave people with. Governance has survived some hiccups and some unforeseen, largely unforeseen situations. It's recovered. We have a new governance portal coming very soon that will solve some of these issues. But in the meantime, I just want to thank all the voters who did vote, and the people that are sitting on the fence. Please come out to vote, because it's critically important that even if you don't think that your maker is going to make a difference, trust me, it does make a difference. I need to convince myself of that quickly, because I'm not a whale either, but I do vote, and I hope that everybody else gets out there and does it too. I think that's where I'm going to leave it. I think let's continue to think about some of the edge cases with governance, and let's think about how that signaling works in the community. And at that, yeah, I'll leave it there. So Cyrus, I'm going to hand that off to you.
Yeah, just I also think it's interesting to reflect back on all the social media attacks that we were withstanding for about a month, right? Where there was a lot of absolutism with this is never going to work. There's no chance it's going to work. And then when it finally did get fixed, it just kind of everything went silent.
Yeah, it's tempting to. I think that secretly we can pat ourselves on the back a bit, but there's a certain amount of grim satisfaction to watch these alarmist contrarians suddenly just move on to greener pastures.
Well, I'm not saying it just to be petty, but more along the lines of there will be times where governance decisions may appear unpopular, or there may be other incentives at play for people not wanting policy to go a certain direction. And we just have to be aware of that and trust in the scientific governance process.
Yeah, actually, that's great. And I wish that I brought that point up, because it's so good. That and it's a risk that we ran into in the past, where sentiment, just crypto sentiment, I began to be concerned that that was actually moving voters' behavior. And I think that they've largely been resolute in what should and should not be done. So yeah, that's a great point, Cyrus. That's one of our takeaways here, is that sure, the subreddit may explode with trolls and people that are synthetically enraged for some reason. But as long as we look at the numbers and we listen to the analysts, I think we have a good data point right now that everything is going to work out, as long as we don't get scared. All right. Thanks for that, Cyrus.
Okay, cool. On to the DAI price. Vishesh, do you want to take it away?
Yeah. Okay. Can you see my screen?
No, I can't. Looks like I'm going to have to manually pin it from.
Yeah.
So for everyone else on the call, there's an user in the user list called presentation, Vishesh Chaudhry, and you'll have to manually pin it to see the presentation.
I guess that's going to be a thing from now on. All right, so to just start off here, I'll give everyone a second, but to just start off, so this is a visualization we've used for the past couple weeks for the DAI price. It's been interesting to see like this semi-normal distribution. It's usually centered around $1, or at least it has been for the past, I would say, couple of weeks. The last 4 or 5 days, it's been pushed up slightly, actually, which is very contrary to what we would expect. And I think this kind of speaks to what Rich was alluding to, which is DAI price is actually fairly well supported compared to what we would have expected with what's been going on with ETH price. And we can touch on sort of why we think that's happening. But the volume has been relatively healthy, hovering around 2-3 million. The price, like I said, just slightly above $1. There were a few dips, but by and large, this is where it's sat. The majority of the volume has been on Oasis. There's a slightly higher bump for DDEX right now. That's just a blip. And then Uniswap has actually been holding fairly steady as a pretty big place for DAI to be traded as well. So to just touch on what's been going on with the price. So, you know, like I said,
did Vishesh time out?
Maybe. I thought it was me who timed out.
Yeah,
Yeah,
I
I
thought it was me
was
too.
waiting to see somebody moving in the sidebar to see whether it was me.
I thought everybody was frozen.
Vishesh, we lost you for like a minute.
Yeah.
sorry about that. Yeah, so where I just kind of left off was the DAI price, as mentioned, had been coming up fairly steadily, and there was that significant event a couple of weeks ago, and since then things have actually been pretty quiet, which is interesting because things have been all but quiet with ETH price, I feel. So this decision to drop the stability fee was very recent, and usually we don't see the effect of the stability fee change on price and supply until a little bit afterwards. So we do have to still wait and see to make any conclusions from that. But initial signs are actually much quieter than expected. So that's good news, I feel. This is a little bit noisy, so I'll just take off a couple of these lines. So, you know, the volume weighted average, the simple moving volume weighted average has been kind of consistently rising over time, as DAI is now kind of proof that it can punch up above the peg. Similarly, ETH price has been making, like, basically tracking those exact movements. So what's really interesting is a lot of the relationship that we'd seen in the past between ETH and DAI has actually fairly reversed over the past few weeks, and that's something else that that I think we should discuss. In terms of what's been going on with draws, wipes, and supply. So supply has actually not significantly changed in the past couple of weeks. So like I said, a lot of quiet. It's come down consistently since mid-April, but since the 19.5% stability fee increase, there was that little bit of a run-up that we talked about, and then since then it's been fairly steady around 81 million. There's been a lot of movement in DAI, but the supply has not changed significantly. So that's something that I want to touch on in a bit, because just scroll back up for a second. The volume, the sort of daily volume has been significantly higher in the past 2-3 weeks than it had been for the past 2-3 months. But the supply has held relatively steady. And I think a lot of the activity that's been on DAI recently has actually been on a lot of these secondary markets. So I think that's a topic for us to explore further and start to talk about a bit more. The age of debt, as mentioned prior, has come down significantly in the past couple of weeks. This speaks to an increased circulation in loans. So, you know, as we said, more loans being paid back and some newer loans being taken out. But as you can see from the supply, that kind of effect has balanced out between the two. So that's good.
Can we talk about this for a second? Is that healthy, unhealthy, or ambivalent, that behavior of like
Yeah, I would call it healthy. I think you need, and I've kind of championed this idea a few times, I think you need that circulation of debt to, it's just good for setting expectations in terms of fees that have been realized versus not, which is always just a risk to keep in mind. And then B, I think as those kind of costs are realized and affected in the short term, I think that's healthier in the sense that if there's a 19.5% stability fee and people are kind of ignoring it and putting it out of mind because they're long-term leveraged and they're not worrying about it, you know, until 2, 3, 4, 5 months later, you can potentially get into some dangerous economic scenarios.
Well, one question on this: do we have? If you can go back up, do you have an overlay of what the stability fee actually was at that point around May, whatever that looks like, the 10th, when it started to really contract? Was
Yeah,
that when it hit? Was that when it hit 19?
Yeah. Yeah, that black line is.
Oh, sorry, that was the number. Thank you.
Yeah. So there is the potential sign of this like starting to slow and level out now, which I think is to be expected. So I don't want to make too many conclusions off of tiny data windows, but what I would start to expect, and I think, you know, we might see, is that this age will kind of level out into roughly like an equilibrium point. And so I think there will be this moving equilibrium point for a given supply level, right? So for 81 million DAI, we would expect over time there shouldn't be significant movements in the average age of DAI. There should be some sort of rough equilibrium for how often people draw out loans and pay loans back. I think what we've seen is a lot of, I'll just expand the scale, a lot of choppy movements in the age of debt and a lot of increases and sudden drops. That to me is what I would consider unhealthy behavior, because that's kind of the system constantly in flux and a lot of major state changes. Yeah.
It's just purely market sentiment, those peaks and valleys, right?
Right.
The stability fee was appropriate.
Yeah, and I think that's a good point to consider, and probably more of a decision point and less of a data point is what's the right relationship between price movements and the state of MakerDAO? Because in the past, I think a lot of the state has been kind of bullied by price movements, but what's happening recently, which is odd but potentially healthy, is a little bit more immunity to some of those price movements in terms of what these equilibrium points are for DAI supply, for DAI price, for average age of debt. I think we're just seeing more stability all around, which is a good sign. So I'm going to skip over the compound section here for a second because I'll talk about that in a different context. But the percentage of new versus old DAI, I mean, we can talk about this, but I think just the amount of DAI being drawn out has been relatively low lately, and this line is kind of dropped down, but to a fairly stable level. So effectively, there's not there's kind of a more stable equilibrium point, again, of what I've been talking about, between the amount of loans that are taken out on pre-existing CDPs versus new CDPs being created and new loans being taken out on those. So collateral is another really interesting topic, especially with regards to a lot of the ETH price movements, because, you know, there have been a few large sort of collateral removal events that have coincided with a few large increases in ETH price, which is kind of an interesting relationship if you think about it, because what we would generally expect is this collateralization ratio to hold relatively steady. In the past, it has held relatively steady, but with the May sort of crypto spring, whatever the proper term is, that collateralization ratio shot up and has actually kind of wavered around this 530% line, despite a few large events in terms of ETH being taken out. So, you know, as ETH price appreciates, people decide, hey, I don't need to keep as much collateral in the system. I feel fairly safe, so I can, you know, back out of some of that capital cost. As opposed to what had happened in the past a bit, which is as ETH price had run up, people had kind of kept that buffer and then taken that as a signal to draw more DAI out of the system. So what I'm just saying is that's a slightly different response to the same stimuli. So that suggests that the nature of the system has changed a bit. And so what I think this actually speaks to a lot more is the actual effect of the stability fee and some of the economics that have been discovered, I guess I would say, with a lot of these secondary lending markets. I mean, you've heard probably anecdotally that DYDX has experienced significant volume, and there's been a lot more refinancing to some of these secondary platforms. And I think people are starting to see them as more of a viable place to get DAI. And I think as the demand for DAI increases, like those are basically an efficiency function. So let's say the demand for DAI is, roughly 70 million, and there's sort of this 10 million buffer of oversupply. If that can get eaten up through a lot of lending on secondary markets, then what you could actually see is a more close tracking between DAI supply and DAI price. So, if the demand for DAI significantly increased, you would have less of this buffer living on Maker, and I think a lot more on these secondary lending platforms. And so you could see a more immediate effect from changes in demand. So to me, that's just kind of the market maturing a little bit, I would say. And so I do want to touch on these secondary lending platforms in a second. So
sorry, hold on. I have a question about that. So, sorry, did you say that the high collateralization ratio is a sign of the market maturing? I mean, I don't expect people to just perpetually or continuously have 5-to-1 ratio locked in voluntarily.
Yeah, not the high collateralization ratio, but the increased activity of people moving a lot of these loans to secondary markets when the rates are cheaper. Right. Because that's sensible behavior, that's efficiency. And so it doesn't make sense to me why you would draw DAI from Maker when the rate is higher. And so there's always been kind of this buffer between the Maker rate and the rate on these secondary lending platforms. What we're just starting to see now is basically more utilization of that rate. And so to me, that's just kind of increased efficiency realizing in the market. And so I would call that maturity.
So what are some rationalizations for the high collateralization ratio? And do we know what it was last year on the way down in the bear market? Does your chart go back?
It does. So what time range are you particularly curious about?
The second half of last year.
So what we saw was the collateralization ratio, as I said, was a lot lower. And I would say more volatile.
To me, it says that people are, because of the bear market, they're just perpetually scared of being liquidated, especially because of the penalty and associated and just general volatility that even at 400% or 500% collateralization, they just prefer to keep it in.
Currently, yes. So what I was saying was in the past, there was kind of A, more risk-seeking behavior, and then B, I think this was just kind of once burned, twice shy type of situation where there were, and I had shown this in the past, but I took it off of here so the site would load faster, a fair amount of liquidations. And so when ETH price volatility is significant, and then there is a large quantity of liquidations, naturally you would see a rise in collateralization ratio because people sort of smarten up or get scared of getting liquidated. Right. What's interesting is more recently, this kind of relationship between the stability fee increases, the DAI supply coming down a bit, and the collateralization ratio increasing, and ETH price running up only in the last month or so, right? So this kind of rise has predated the most recent bull run in ETH prices. Now, what I'm saying is, in part, there is a bit of a risk aversion in the sense that as ETH price comes up, people imagine the potential energy is higher, there's a greater height to fall from, and so they do want to keep to some extent that buffer. But what we had kind of been scared of, I think, or what had been a potential concern in the past couple of weeks was with this significant buffer of collateralization ratio and a large quantity of DAI that we know was purchased in exchange for ETH, that people were then going to take that DAI, wait a little bit, and dump it back into ETH. What's interesting is, and it may be a function of the fact that ETH price has been increasing and the other shoe has not yet dropped. That's entirely possible. Or it may be a function of these like loan refinancings. It's very hard to say, but we have not seen that like large quantity of DAI getting flooded into the market and DAI price dropping, which was definitely a concern. And the other piece is that this sort of buffer in collateral has been maintained, but as ETH price, like I said, as ETH price has come up, instead of choosing to draw out more DAI, people have chosen to take out some of the ETH to balance out the capital cost.
So another interesting aspect is that the lending market for ETH is not nearly as active or profitable as it is for DAI. So I mean, all this surplus ETH that CDP owners have locked into the system, it's not like they can take it out and earn kind of that 10 to 15% that you could get for DAI on other platforms.
Well,
but you could borrow DAI against your extra ETH. And so why aren't we seeing that? And right. I guess we should talk after this. We should talk about this DAI supply as well. I mean, you referenced it.
But I think that's exactly what I was gonna say was, yes, you're not gonna get a huge yield for ETH, but you could totally dump it into another platform, use it as collateral, and draw out USDC or DAI or something else, and then try to construct another trade off that to get some yield. So, why aren't people doing that? Great question. I think to some extent, there's a lot of uncertainty in what that potential yield might be, especially when people have to go through multiple steps of exchanging currency A to currency B to currency C. And then B, I think to some extent people want to maintain, and it's kind of hard to explain demand mechanics, especially when we don't have like a lot of spotlight on the demand sources at the moment. But like, why would you maintain 80 million DAI in Maker at a 19.5 or a 17.5 now percent interest rate when you could maintain roughly the same thing in Compound for 14 to 15%? That's an important question for us to consider, is why is there even the DAI supply that currently exists? What is it about Maker that is the differentiator that people prefer DAI from Maker versus DAI from another source? And I think whatever that reason is, which I can't just simply answer for you here, will kind of be the upstream answer to why people are maintaining such a significant collateralization percentage on Maker, because they're not ready to let go of their CDP positions for some reason. So just wanted, and I don't want to eat up too much time, but I do want to touch on some of the secondary lending stats. So I've kind of played around with LoanScan's new resources, their API, their updated UI, which are all great resources. And what's been interesting to see is leading in terms of new loans being drawn out is roughly a balance between Maker and Compound. So it seems that Compound V2 is one source where, and they don't have DYDX in here, which is another platform that's been on the rise in the past week or two. But what we've seen is, roughly the same amount of DAI being pulled out of Maker versus Compound. So it seems that some of the new DAI that would normally have been drawn out in this particular type of market scenario is being drawn out from other platforms and not Maker, which contributes to part of the reason why some of that supply has held steady despite this ETH price rally.
Vishesh, at what point does that become a concern for us? That Compound is more of an attractive source of DAI than
I think what I was trying to say earlier is it should always be a concern, in the sense that we need to constantly wrestle with the question of what is Maker's relationship in the ecosystem. And like.
Well, let's talk through that for a second. I mean, unless I'm totally out of whack on this one, the only way DAI can be minted is via Maker. So it is created and destroyed via Maker. The fact that it's cheaper in a secondary lending platform, at least from my perspective, implies the Maker rate is overpriced for where it should be today. And we see it kind of on a synthetic number that we're trying to get to the peg, we're at the peg, we're at 19.5 or 17.5 in one hand, and there are secondary markets that are cheaper. So that delta, that $10 million delta, the theoretical $10 million gap, it's a question of when, not if, but when people decide to refinance their CDPs with more cheaper loans per se. But it still can only be created and destroyed with one system. It's a natural arbitrage. We will get to that harmony of 70 million if that's actually the demand number. And then once we do, and once we do, the Maker rates will be on par with the secondary lending platform. It's kind of the corollary of having algorithmic trades where they in effect put each other out of business, because you have everybody trying to fight to capture a millionth of a penny or a 10,000th of a penny, and then it turns into 1/100,000th of a penny. It's the same model, except this is so slow, at least in my eyes. Could be totally wrong, but it's a slow system where if there's a $10 million gap, it's just going to take time for people to refinance those numbers down.
Well, it's also ultimately a question of supply, right? Like the DAI only comes out of a CDP, and this secondary lending, the DAI available to be dropped into Compound will dry up at some point, and the only place to get more DAI will be a CDP, right? So we're going to hit that lower bound where the premium on pulling it out of a MakerDAO is going to be unavoidable. Isn't that the case?
Yeah, so that's actually a point that I wanted to touch on. Is I agree with what Matthew's saying in terms of the relationship is always going to be that kind of generator point. And these secondary lending platforms, what I was saying earlier, do create kind of this efficiency buffer in the sense that if DAI is overpriced on Maker, there's that arbitrage opportunity on the secondary lending platforms. And so it helps people obtain DAI at the rate that they really want to obtain it. But there is definitely a structural question of, is it really a bad thing for that natural arbitrage to exist? And I'm not going to answer one way or the other, but I'm going to suggest the potential that it is more stable to have those secondary lending platforms at that discount to Maker, rather than trying to chase, which has been suggested before, the rate that those secondary lending platforms offer as kind of a new point for the stability fee. Because a stability fee of 14% with versus a stability fee of 17% with a 13-14% lending rate on secondary platforms are not the same thing. And in the event that there is a large amount of DAI that's dumped onto the market, or flipping back to the previous market economics where DAI price suffers and DAI supply increases with a increase in ETH price, in those scenarios, there's, I think, an additional stability benefit to having those sort of separate nodes in the ecosystem, in terms of MakerDAO being the generator of DAI versus the secondary lending platforms kind of being this almost UI layer to consumers where they go and get that cheaper rate. I don't think those two scenarios are the same thing. And in the event that you just have Maker and you don't have kind of these significant buffer volumes on these secondary lending platforms, you could run into the potential scenario where you're kind of exposed to the price movements again. And a significant change in ETH price bullies the DAI supply on Maker again. And that could have serious ramifications for DAI price.
I look at it as being a very basic version of the DAI savings rate that's coming out. It ultimately destroys the DAI supply because it allows people to refinance their outstanding DAI. It makes the system more efficient, but it's not in the purview or the control of the Maker system.
Yep, I totally agree with that statement. So there's a question of and I agree. I think it's a really good point to point out that it's kind of a makeshift MacGyvered version of the DSR. which is, I think, a very interesting take. But yeah, there's a question of whether or not that's a bad thing. I don't think it necessarily is. I think it, in the absence of a savings rate, does lend an additional stability layer to Maker. And I think it is, from a biological standpoint, I think it's cropped up for a reason. A lot of these platforms have popped up. They've gained significant traction because there is a real place for them in the market, and there is a need for it, especially in the absence of the stability savings rate. Sorry, and I don't want to eat up too much time, so I just want to punch through the secondary lending stats real quick. So what's interesting to also note is repayments. So this speaks to a lot of what I've been talking about. There are more repayments. So, if there are similar amounts of draws for Maker versus Compound, and there are more repayments on Maker versus Compound, then that tells you, what's going in is coming out the other end. And there is this kind of measurable refinancing from Maker to Compound at the very least. And this is not updated to include DYDX, but when we look at DYDX, I think you'll see a similar effect there. That's really been gaining a lot of movement in the past week or so. So sorry, yeah, I think that's everything that I wanted to run through. I know that was a ton of time. Happy to answer any follow-up questions if there are.
I think that we have Matthew coming in for his thought of the week, but and there was a significant number of questions for you, Vishesh. Maybe we should tackle those at the top of the hour. And Cyrus, how do you actually want to play out the last 15 minutes we have left? Do you want to do the risk, the collateral stuff after 10?
Let's do Matthew's thoughts and then answer some questions, and then we'll just do the collateral stuff at the top of the hour or afterwards, I guess. I don't know. I hate to break flow and kind of go back and forth.
Well, I'll leave it up to you. What do you want to do?
Yeah, that's fine. We can go ahead with. We can continue on the same.
All right, Matthew, do you want to give us your thoughts of the week?
Yeah, I mean, so basically, this is just a continuation from from last week, and it relates back to how we can start putting together a machine learning and PID pieces of this. So starting to kind of assemble a community-driven movement or a team about what we can do to put together a working group to optimize this. And it's in many ways it's very similar. And I kind of wrote about this. It's like whenever Tesla put together the concept of like an autopilot or driving a car within the lane, and that lane for the time being, well, let's just say, is a targeted stabilized peg. And the question is, what are the market forces that cause it? Whether or not it's a stability fee that causes or destroys supply. And the same thing with the DSR. And both of them have corresponding effects, and how that can be treated to the corollary of wind, and what other pieces cause a correction to cause an algorithm to keep the car more or less in the lane. And we have all sorts of, I guess, data points, and there's no shortage of the data. The question really is, what is the correlation on the data, and how we can pull those in on both the DAI price, the ETH price, anything that could be corollary that can cause wind per se, that can include Bitcoin. And this notion of how many inputs you put in there allow us to kind of abstract away, not necessarily predict, because I don't want to get in the mode of forecasting. It's more of historic associations that, let's just, as an example, if we can find a way, and this is hypothetical, but if we can get the data from fiat on ramps that are pulling fiat into an exchange, let's say Coinbase or SendWire, just of the gross dollar amounts, it's kind of the corollary of saying, is there a storm building? Doesn't mean anything's going to happen, but then we can start to see if there's wind and what kind of impact that would have on keeping the car in the lane. All of those things, if we optimize them, and that stuff takes time. So this is a full-on shout out to any AWS engineer that understands AWS inside and out, that does machine learning. Please contact us, put it in Reddit, and let's start the discussion of how we can implement that. That's it.
Okay, cool. Thanks, Matthew. Yeah, and let's continue that discussion in the link that I posted in the slide too, and the discussion thread for the call, because this is part of a larger initiative that we're exploring, and that's, well, Cyrus, I'm not going to speak for you, but well, I just said I'm not going, but I'm going to. We're intensely interested in attracting talent from the community. It's been pre-filtered and pre-selected and pre-sorted, and we have the talent here. So if you have ideas about how you can contribute, or if you're have data models or you understand machine learning, then ping us and let us know what you can do. All right, Cyrus, how do you want to take the rest of the call? We had the risk stuff.
Yeah, let's just spend a couple minutes on any important questions that we had from the presentation.
Yeah, Vishesh, if you want to take a look at the side.
I think just maybe the main takeaway for me was the static DAI supply. It's been stuck at 80 million for quite some time now, despite the huge ETH rally. And so I think it warrants some revisiting of our earlier hypothesis from a few months ago about the negative correlation between DAI price and ETH price, and potentially looking at some alternative indicators such as ETH price sentiment, which is more of a relative metric as opposed to absolute number. And I think that's some of the stuff that Vishesh and Primosh have been working on in the background, is trying to gauge the sentiment at the current price, or essentially what the demand for leverage is.
One thing, sorry to interrupt, David, just one thing I just want to put out there is that on the OTC angle, which we don't have a lot of stuff on here, is that it's getting a little harder to source big blocks of DAI. And this is coming from some of the major OTC desks where you want to buy 2 million, 3 million DAI, it's getting a little more difficult. So I thought it was something you guys should know. Just because the stability is so high, maybe you have to get more people to DAI prices go higher for people to go issue more DAI at these prices. But thought the community should know.
Yeah, I feel like there is a healthy level of increased speculative demand as the ETH price, or as the kind of all crypto markets go up, right? It's almost concerning to see no new DAI generation given the recent rally. So I feel like
Sorry, go on.
Go ahead. No, go ahead.
I'm not 100% sure that that's concerning. So what's I think a good data point, it's helpful to understand what's going on in the OTC side. I think that lines up with what I've been observing on Uniswap, for example, where, and this is a bit anecdotal, I don't have the data on this just yet, but I think smaller trades than prior affect more changes in the exchange rate on Uniswap. So I think there's less liquidity, and that I can go look at the liquidity pool and check on. But what my sense is that liquidity for DAI at current demand levels is less than before, because demand levels are actually higher for the use case of leverage. And that's something that we could go and confirm and actually measure. But I think what's going on is there's an increase in demand, but not enough to where demand dries up liquidity to an extent that DAI price goes up enough to effectively cause people to draw out more DAI, because people are able to currently source it from these other areas that we're talking about. And so if you kind of think about that, there's this margin or this buffer that exists between where the supply is and where the demand is. And I think what's been going on lately is that the demand has been able to rise, and that margin has been able to narrow with the same supply levels. Whereas in the past, there was a larger margin between those two. And so changes in demand levels affected greater changes in supply. And so that's kind of my sense of what's going on at the moment. So if this continues, and I think that's not necessarily bad, is my point, because what that means is you can have a theoretically more efficient supply that tracks to demand a bit better. Now, as if demand continues to increase, then you would see an increase in supply if that hypothesis is correct. So I would just say I don't think it's necessarily a bad thing.
Okay. Cool.
Especially in a world where the secondary lending rates are lower than the stability fee. If we get to be the other way around, then it is concerning. If we have, for whatever reason, the secondary rates would be higher, which I can't imagine that, but imagine they were, and we had an underlying price rally in the collateral, and we didn't see a DAI outstanding increase, then yeah, there would be an issue.
Yeah, that would be a very strange economic situation. And I think we really want to be cognizant of that buffer, for not for the purposes of setting the stability fee, but of just understanding the dynamics of what's going on, being aware of how thin that margin is between secondary lending rates and the stability fee. Because I think it probably, and it's very hard for me to say from like a scientific standpoint, but it probably tracks fairly close between the buffer between demand and supply.
Okay, cool. Let's move on for the last 5 minutes, so I can give a little spiel on collateral risk. So, as you guys all know, collateral risk will at least slowly start to filter its way into these discussions for a variety of reasons. Primarily, obviously, because we're on the cusp of multi-collateral DAI, and there is a lot to unpack there. And monetary policy, at least for the very current time, is doing okay. So I'm just going to kind of give a brief introduction of how I'm thinking about it, or how we're all thinking about it internally. And I want to emphasize that just like the monetary policy discussions, we're hoping that these primarily take place offline, Reddit, social media, and so forth. We want to just try to seed ideas here. And in some respects, it's actually more important because the monetary policy is somewhat of a reactionary process where we are just looking at the DAI price and adjusting the stability fee one way or another. But with the collateral risk, there is definitely some more forward thinking that's required. We definitely want to jump ahead of some of the risks involved. It's not as pleasant to be reactionary to some of these big collateral moves. So to start, there's going to be a lot of groundwork that we're going to have to lay here on this call and basically over the coming weeks. There's a lot of operational aspects to discuss. We're going to have to start exploring questions such as what kind of risks specifically are we looking for, and how do we quantify them? How do we blend fundamental analysis and the quantitative modeling, and all manners of how to build out the collateral portfolio and maintain it. Additionally, there's going to be a lot of governance issues at play, the risk teams, their incentives. What is the governance process by which we add collateral? As a primer, I would suggest everybody reread Stephen's 3 risk documents. They were phenomenal, and they really set the tone for the scientific approach that we have been emphasizing for the past year. A lot of our risk discussions will be framed in that context. We're also working on some follow-up documentation as well. And yeah, I think in general, we're going to try to keep this as an open discussion, maybe have a light structure in place. I'm going to pause here for questions if anybody has anything to comment on right now. Okay, cool. So basically, I think the overarching picture here is how do we get from inputs to outputs, right? How do we take a collateral and then figure out what its risk parameters are, debt ceiling, stability fee, all that stuff. And there's issues of factoring in the qualitative aspects of the collateral, essentially what does it represent, as well as its trading profile, its market presence, its liquidity, a lot of moving pieces and a lot of analysis to conduct. But I think there's very elegant answers to almost all the questions, and it's just a matter of iterating and building it out piece by piece. And yeah, that's it. I don't really have a ton of information today. I think I'm just trying to set the tone for how the ensuing collateral discussions are going to take place.
I have a question. Is it planned for the DAI savings rate to be uniform across? I know you mentioned the stability fee will be different depending on the collateral type, if I understand it correctly. Is the savings rate planning to be uniform across all assets, all collateral types?
Yes, it is in the time being going to be uniform.
I also have a question. So you're talking about evaluation of individual assets, but what type of work are we planning around looking at, intercorrelations between these assets and looking at kind of the basket of assets that exist on Maker as like a portfolio analysis, or kind of combined liquidity risk? What's kind of the sense of how we want to start thinking about assets in a network and not just individual buckets?
Right. So I think we're going to have to start releasing some high-level overviews and outlines of kind of a end-to-end life cycle of these risk models, and then just approach it step by step. I think it makes sense to actually just redo an analysis on ETH from the ground up, maybe optimize some of the current parameters that we have in place. I think, for example, the collateralization ratio and debt ceilings and so forth were all somewhat defensive, just to protect the system in the early days, but there's definitely room for optimization there. Yeah, and then I think that the proper approach is to just look at a single asset approach, and then factor in, add an additional asset, and then look at their interplay and their dynamics, and continue from there.
So what about assets, like the difference between bringing in something like TUSD versus a Uniswap liquidity pool? Like one's trustless and we can see all the contracts. Right. One is totally opaque unless you start getting lawyers involved and looking at bank accounts and stuff like that.
Right. There's going to be discussions and methodologies in place for basically all manners of risk, including one of the primary differentiators between a lot of crypto assets is whether or not they're bearer assets or not. Obviously, ETH is extremely trustless and extremely easy to facilitate through the keeper auctions and whatnot. And there's going to be some extra steps involved for security tokens or regulated, registered assets.
Are we talking about legal entities being set up for some of those more real world assets?
So I think those? So security tokens is probably something that we should discuss a little bit further down the line, just given its added complexity and given a lot of the legal uncertainty. So in terms of operationally, how it's done is actually a bit of an open question. There's obviously a lot of security token issuers out there, and I believe they all have kind of their own unique way of handling these situations. So we're just going to have to kind of pour through it carefully and understand it and take it from there. One instructive example for evaluating collateral types is along those lines is looking at something like Bitcoin or Ether versus something like Tether. very different risk profiles. So, for example, if you were to look at Tether purely based on its trading history, its past profile, you'd actually think it's probably pretty safe. And obviously, we know that to not be the case. And looking at something like Bitcoin or Ether seems to be extremely volatile, but in a lot of ways much safer than something like Tether. And so it will be interesting to kind of unpack these different situations. Personally, it's something I'm pretty excited about. This is my favorite part of crypto, but it can be a bit complex at times, for sure.
So, quick question: you're talking about kind of sort of a fundamental analysis of different assets, but how do you sort of think about not like an asset as a single static monolith, but also as kind of like a moving sum of pieces? So in particular, I'm thinking about like order books, trades, liquidity. Like the value or the price of an asset is one thing, and then what's realized on the market through actual trades and through like real time liquidity on the order books is a very different thing often. I know for ETH, like it's a very big asset it may track, but especially for a lot of longer tail assets, it's going to become very tenuous to consider what's the long-term stability of that asset versus what's been the long-term liquidity of that asset. Right. So what we're, in particular, what we're concerned there is our expected liquidation value, which is where if MakerDAO has to dump the asset on the open market, how much value could it realize relative to spot? Basically some estimate of the slippage involved. And yeah, if you have that long tail of very illiquid assets where you try to sell, $10,000 of XYZ coin and you only end up with $2,000, then essentially what that builds into is the collateralization ratio, which is actually primarily a function of how much slippage you will incur during the liquidation, which is actually why I think in certain cases the ETH parameters can be optimized. We've had hundreds of liquidations, and they never once went below. They never once incurred bad debt, right? So for the given stability fee, you could argue that the collateralization ratio was way too restrictive. That's a good point. So this kind of was the reason that I originally brought up some of the asset interactions, because the liquidity of an asset is not like specific to that asset; it's specific to pairs. And so, like DAI ETH liquidity may be fairly strong, but DAI USD liquidity may be lower. And so, there's kind of that question of how do you then start to think about what are the pathways for exit for a given asset, and like do you just do like a blended weighted average or? Right. So I mean, obviously all of our options are against the DAI pair, right? But I think for practical purposes, you can assume that that arbitrage situation, you can use the USD markets as a proxy for liquidity, whereas you probably wouldn't use the Bitcoin based pairs as a proxy. Although, I mean, if you really wanted to get deep enough into the analysis, you could. But I just suspect that for most assets, the USD pair should suffice. Right, because if you were going to factor in the Bitcoin one, you'd also have to factor in the Bitcoin DAI pair, because that's essentially the path they would get from start to finish. Might be a little bit noisy.
It becomes like a little bit of a transition matrix of just like, what are the intermediate steps? They all just kind of contribute to the ultimate path from A to B.
Right. Well, I don't.
Cyrus?
Yeah.
Sorry. Do you think we could use some TCRs, or should we develop our own one? How do you see
TCRs?
Token curated registries.
We are the TCR.
Exactly.
MakerDAO through its governance and its assessment of the risk parameters, actually is a live TCR, yeah, MCR. Actually, that's an interesting. Let's actually talk about that for a bit. So, as we evaluate, kind of from a fundamental perspective, these collateral assets, it's actually very similar to what the ratings agencies such as Moody's or S&P does, and we're actually filling that dual role of being the lender as well as being the evaluator of the asset, and that's because there really is no official Moody's for crypto right now, and so who better than the ones taking on the risk anyways. You can envision in a kind of a distant future when crypto markets are more mature and there are more collateral assets than MakerDAO or the Maker Risk teams can reasonably evaluate, we can outsource that to professional services, or actually those professional services essentially are the future vision of risk teams.
How would those professional services be compensated under, a system with MKR?
Right.
Would
So
they
in the
hold
same
MKR?
sense that you would, in the traditional world, pay these ratings services for their analysis, MakerDAO might or likely will have the ability to compensate analysts for their services as well. So it becomes a bit tricky with, do you just want an objective evaluation of a collateral asset, or do you also want a kind of a risk evaluation? And incentives definitely come into play here, because you want everybody to be on the same page for sure. But yeah, that's something we're gonna have to see how it evolves as time goes on.
So that kind of begs the next natural question, which is, how are those analyses and how's that information presented to the community? How does the information disseminate, especially with regards to, like, presumably a very long-term project around building these collateral asset models? To what extent is the community kept looped in, and how is that information shared?
Right. So the way I'm looking at it is kind of just some sort of step-by-step evaluation process. Typically just starts with the classification of the asset. Basically, what is it? Is it a bearer asset or security token? Is it a work token, governance token, utility token? Right. There's some pretty decent established theory around various token models and the value that they subjectively have. So first step is just kind of pegging it down on what kind of asset it is. I think the next step is creating some sort of due diligence model, fundamental evaluation, maybe even create a numerical evaluation model to give MKR holders some notion of what this asset is actually worth. Just think back to the height of the bull market in 2017. Would you accept a collateral asset that's market price is $3 billion when, according to the valuation theory, it should pretty much be worth zero, right? Kind of no risk parameter will protect you against situations like that. So yeah, first few steps is definitely just gain a very deep understanding of what the asset is, what it's worth. And then you can actually start digging into what are the risks associated with it. Technical risk, legal risks, operational risk from the team, contract risk, bugs, backdoors, all sorts of things. And these kind of edge case risks will basically build into the risk premium for that collateral asset. Just think about if someone took a loan from you and they put up Tether as collateral, you'd probably charge them a pretty high interest rate given the risk associated with it. And that's just purely qualitative risks versus giving a loan out on much safer collateral. So essentially, a lot of these fundamental evaluations, this whole TCR ratings agency aspect, will primarily factor into the collateral specific risk premium.
So just one, maybe more of a thought, less of a question, is if we consider kind of the different types of price movements that lead to different types of risks in the system. For example, if an asset is hacked, there's a sudden immediate black swan event. That's a different type of risk. If an asset we know is, something happens to the dev team, etc., its fundamental value drops and the price drops slowly and consistently over time, that's a different type of risk. Versus if it's fairly stable over time, but it's very volatile, that's again, yet another different type of risk. So how are you thinking about sort of building a taxonomy of these different types of risks and communicating that and organizing that information?
Yeah, I mean, that's actually the meat of it. That's basically the crux of the entire analysis. And it boils down to trying to find out some estimation of the probability of a CDP being liquidated. Because that's really the building block for everything is CDP analysis, and thinking about CDPs as loans, regardless of if it's what it's collateralized by, Ether, some other coin, or even a hypothetical under collateralized CDP that has a reputation or credit score attached to it. And essentially everything comes down to trying to model out the probability that this CDP is liquidated, and then a conditional loss distribution given that the CDP has been liquidated. So, and that will kind of factor in that that tail risk that you were just mentioning.
So what we're effectively saying is like how likely a CDP is to be liquidated, plus how severely that CDP is liquidated.
Exactly. Those are the two most crucial aspects of this entire collateral risk model.
In that sense, I would suggest maybe also we think about like the entire pool of so it's not just for an individual CDP, what's the likelihood of getting liquidated and how severely it's liquidated, but then also within that distribution for all the CDPs in the existing pool, how many of them are liquidated in what way? And so kind of then like thinking about one big CDP that is liquidated to varying degrees.
Well, I mean, and one of the metrics you need to include in all of that is any type of correlation between the two, so that if, what's the probability that if you end up having some type of liquidation in token structure A, that would have some secondary, tertiary effect on others.
Yeah, and that's where a lot of the like order books and the trades and liquidity come in, because I was thinking about, if asset A, 50% of the CDPs are liquidated, and there's a huge sale in asset A denominated in DAI or in asset B, and then asset B is also liquidated to like a 30% extent. What is that? How much does that change the overall price that you're able to get?
Yeah, definitely. This is all been specified. There's a ton of precedent for this, and just to cut to the chase, basically no great way to do it, at least in the space of crypto markets, because crypto's new and there isn't a ton of historical information, and in fact there isn't even a ton of current information, and by that I mean any kind of market implied metrics for some of these risk parameters that we're interested in. So typically, if you were looking at portfolio of traditional assets, you would look at there are kind of several different ways of doing it. One is you could just look at historical data. If you're looking at loans, you could look at historical default frequencies. If you're looking at collateral assets, look at the price history, and so forth. Or you could even separately approach it from kind of an options framework and look at market implied CDS spreads, market implied volatilities, and build out models that way. The bad news for crypto is that we don't have any of that stuff, but the good news is that all crypto is correlated anyways, so we don't actually, for as long as we're just adding kind of the standard crypto ERC20 assets, we can actually abstract a lot of that out and just assume extremely high or even perfect correlation. Anyone who's ever looked at CoinMarketCap can tell you that. So then really, at least for the short run, the model converges back down to, okay, what is the probability that any of these CDPs are liquidated, whether it be ETH or any other crypto asset, and then also trying to figure out how bad the liquidations will be.
I suppose the general request, I think, is that we're over an hour into this call and we haven't even gone over any one of those collateral types because they don't need to, because they don't exist yet. But probably when we actually start adding them, just in general, I'd recommend that we try and bifurcate this call into having general governance and then collateral calls to go over those, or some other structure. Yeah. I don't know how we're going to efficiently.
Yeah, we've talked about that at length, and something we are still working out the structure of this call, especially now that it tends to run minimum hour and a half. But yeah, that's a good point, because there's definitely a lot to discuss.
Yeah, I have a quick question. I read someone posted on Reddit asking if it's true that or whether or not the bullishness or the bearishness or the directionality of the collateral token has any impact on the stability fee. So like, what the example would be, let's say there's a token that we think is going to have very low volatility and very high liquidity, but at the same time we're very bearish on it. Does that give it a higher stability fee, or does that keep it the same because we think we'll be able to liquidate it properly?
Yeah, actually, somewhat counterintuitively, it really would have a negligible effect on the stability fee. And this is what I was trying to allude to in my preamble about specifically what kinds of risks we are looking for. And it's actually not just kind of small market movements or anything that it's kind of, I'm not great explaining it, but essentially we want to look at tail risks and highly unexpected events. If you are bearish on the token, that's kind of something you can plan for. And if you can plan for it, there are ways to handle that. You could, I mean, you could increase the stability fee. You could also increase the collateralization ratio. But really just kind of standard market volatility or downward bias isn't necessarily what we care about.
I don't.
It's correlated with what we care about, though, for sure.
I don't think you'd have to do much of anything at all. I mean, this was an analysis that I initially ran on ETH when first getting introduced to Maker. Was, okay, what happens in the event that ETH price just consistently deflates? And let's say it doesn't drop 30% overnight, but it drops 30% over the course of a year.
That's what we saw last year.
Yeah, I mean, it's actually kind of good for Maker, or at least there's an argument to be made that it's good in the sense that when there's a lot of long-term slow price depreciation, you actually have a healthy balance of liquidations, and liquidations are not bad for the system. It's under-collateralized liquidations that are bad for the system. And so like when liquidations occur, they actually just keep that debt circulation up, they keep realized revenues up, and they're not necessarily a bad thing. What's, the concern is exactly what, Cyrus, you're talking about when there's sudden events, but especially with ETH price, we saw that as the price kind of deflated over time, it was actually fairly positive for revenues and fairly neutral for pretty much every other metric.
Right, exactly.
All right, thanks, guys.
Yeah, and that kind of definitely opens up the conversation about why it's so difficult in the first place. in that you can envision a scenario where ETH does drop by 30% overnight, right? Protocol hack, some, you could come up with some pretty grim scenarios of why ETH price would crater, but it's actually pretty much impossible to estimate what that probability actually is, right? Is it 10% or 20% or 5%, right? And essentially what all these numbers come back to is once you have some estimate of your expected worst case scenarios, your expected losses, you want to kind of take a look at that overall picture and see, okay, is this an exposure that we are comfortable with as a DAO? So for example, if we have billions in Ether versus billions in a bunch of really risky loans, how do we define how much exposure MakerDAO can actually hold up to? Which is another interesting question that we will be discussing.
What is there any thoughts about how you scale up governance to manage, including collateral types? Because I feel like even with the just adjusting stability fees, there's lots of meetings, there's lots of drama on Reddit, all this other stuff, and the risk team has limited bandwidth. So how do we add not just the first 5 collateral types, but 100?
Right. Well, there are some ideas and plans in place. Just one idea, and this is just purely just brainstorming, is you could have, for example, just one executive vote or one governance vote, say every month or every 2 months, and that one vote would add in 20 different collateral types plus all the risk parameters, and you would spend kind of the prior 2 months discussing each asset on the calls on social media, and then you just vote them all in at once, and then you would adjust them. So the hope is that the tinkering that needs to be done on the collateral specific side is sufficiently low that we can kind of match it up with the timeline of governance. Of course, there'll be kind of emergency situations where we need to adjust things on the fly, and that might take a little bit of work. But in general, we can add collateral in batches, and hopefully just kind of plug and play a lot of the models.
Well, I think that's kind of the key here, though, is right. There's a model that applies to ERC20s in general, right? And we don't need to reevaluate that model for each one that comes down the pipe. Each new potential collateral type, we expand or augment the base model and iterate that every time, and then it should be a fairly straightforward process of just determining what the caps are on each collateral type, right?
Yeah, and although what will be interesting is that the models are sufficiently open for peer review that we might start to see, and we should see, several different, like entirely different architectures for the same collateral asset. And
yeah, it's an interesting question. I think that, and Josh, thanks for asking it. The short answer is we have no idea what the level of engagement is from a governance and risk perspective when we're introducing these new collateral types. It's entirely possible that, like Cyrus said, we can drop a package and everybody says, yeah, that looks great, and we just move ahead. I think that might be slightly optimistic. I have a feeling that we're going to need to figure out where the sweet spot is between decoupling this large set of data into manageable bite-sized votable pieces and then moving them through the system. And which doesn't take into account just the level of interaction with evaluating the models and then debating the individual classes and having these meetings and all the rest of it. I think we can probably be prepared to have weeks and or months of discussions leading up to the first major collateral type vote. And then we'll have to figure out how well that went and then iterate again. we sort just to finish that thought, as an example, we've seen the level of coordination and effort and community interaction and voting portal interaction it took to move the stability fee number up and down. So with that level of complexity, it's not hard to extrapolate what might happen when we start adding 10, whatever, 15, 20 different collateral types in the future.
Yeah, and there's going to be, I actually think one of the more contentious aspects will be debt ceilings. Because debt ceiling is the ultimate metric for scale and growth. Mm-hmm. And there will be this this divide between short-term and long-term health, where people want to see the system scale as fast as possible. And a lot of the risks associated are kind of latent or not immediately visible. You know, people say, oh, well, that's never going to happen. This is totally fine. I think that's just one of the human fallacies that we just see over and over in history.
Yeah, we're also kind of blessed in the fact that we're ETH and DAI maximalists and Maker maximalists in these discussions leading up to this point. When actually I was about to name some of the more rabid projects, halfway I stopped myself. But once the shells discover that we're considering their religiously devoted shitcoin is being considered for a collateral type, we're going to see an entirely new segment of people get involved with this process. That's going to muddy the waters a bit, I think.
Right.
Cyrus?
Yeah, go ahead.
Yeah, I got a couple questions. So initially, do you have any estimates in terms of like how many collaterals we were talking about?
How many? So I mean, it's
yeah.
So it's not up to us, right? This is definitely a governance MKR wide decision, and they can ultimately choose to add in as many as they want. On our end, all that we can control on the foundation risk team is how many assets we can properly evaluate in a limited time span, given just the natural overhead that goes into some of these evaluation processes and quantitative modeling. But if an asset will generate growth for DAI in the collateral portfolio, and we'll have to kind of define what it means to make sense, then anything can be added in theory. And so you could have multiple different risk teams tackling different assets, and then they all get submitted and voted on all at once by the executive vote. Akiva, yeah, I was just about to answer your question. Yeah, I do know about the SPV model, and kind of a brief TLDR. Essentially, certain security tokens are obviously quite illiquid, and they're even more illiquid on crypto markets, right? Imagine trying to find a liquid market for tokens that represent some obscure real-world asset. So the SPV model goes like this. So SPV is created, and there are ERC20 tokens minted that represent a claim on the liquidated value of the assets in the real world. So essentially, if there's that was really confusing, but if there's a liquidation occurs, the asset gets sold in the real world, and then the SPV is legally obligated to convert the proceeds into DAI, and then the DAI would get sent to the ERC20 holders, and then the tokens represent a claim on that DAI. So in the Keeper auction, you would bid on $1 worth of DAI at hopefully a discount, right? And you would get the proceeds of the auction. I'm not sure if that entirely made sense. The goal is to source liquidity off chain and then flow the proceeds back to token holders on chain.
I think Greg said something in his speech where or something like that. It actually doesn't represent a legal claim. So I'm wondering if you could clarify on that. Like, what's
it doesn't represent a legal claim on the assets. It represents a legal claim on the liquidated proceeds of the assets.
Okay.
Yeah, so I mean, think about basically that mechanism as being a hyper efficient version of a bankruptcy court.
Right. Exactly. Yes, Josh, to your question.
All right, I have to jump in again because I have a significant amount of work I need to do, so I can't record this anymore. So I need to stop the recording and move on to my next meetings. If anybody wants to hang out and continue the discussion, they're more than welcome to do so, but it won't be recorded for posterity. Once again, thanks everybody for the amazing discussion. There will be a recap, a summary, videos and audio, and transcripts will be posted to the subreddit and to Twitter. Thanks for coming, everyone. Thanks, Cyrus. Thanks, Smith. Thanks, Matthew, and thanks, Vishesh, for your presentations. That was great.